The Q3 season is here. Numbers are coming in. Absa released their Q3 numbers. As always, we're delighted to have Moses Muthui now as Interim CFO. Karibu sana, Moses.
Thank you, Julian. It's always a pleasure to talk to you.
Moses, let's start from the new designation, Interim CFO. How does it feel wearing a different hat from the strategy side to CFO?
Yeah, look, thanks, Julian. I think it's the same business. Same numbers, same environment. So obviously from that point of view, the continuity of where the business is strategically, what's most important to the business at this point in time, and what we have to continue doing is not new. I think obviously the sense of responsibility with the mandate to take certain decisions, that puts a different bar in terms of expectations. I'm learning a lot more about banking, from the engine room, and so that's exciting. Very credible teams, all the support, and we continue to give 100% support to our interim CEO, Yusuf, and the board to make sure that the future is on our side, and we are very optimistic about the future.
Right. Let's begin from an industry level now, diving into the numbers. Looking at Absa numbers and really across the banking sector, the top line is significantly turbocharged by what we're seeing in the foreign exchange income line.
Correct.
For understandable reasons.
Yeah.
I'm worried about when this tide will recede. Don't you think your revenue profile will come at risk?
Well, I think when you sense a tide might recede, the first thing you have to worry about is, am I covered? For us, we've seen 60% growth in FX income, bizarrely the lowest in our peer set. So on a relative basis, we are not very concerned in terms of receding of the tide. I think what will continue to happen is client demand for foreign exchange and volumes around foreign exchange, which are tied to trade volumes and trade activity, will continue to give because our economy is active and thriving. I think the pricing for that volume is what might begin to mean revert. But as I said, on a relative basis, I think we are very well positioned. I think the conversations now around what sides of this volume should we start building, right? Export and import side, to support that client activity and the client franchise. And knowing that these things are cyclical. So I think if you're operating with a mindset that the windfall is structural, then there might be a problem. So on a relative basis, I think we are well positioned. We can't forecast. We're living with scenarios in lieu of forecasting what happens to that line. But I'm not worried from a relative point of view.
I see.
Yeah.
And speaking about the relativity now with your peers in the industry, when I look, and I've asked you this before, discussing the H1 numbers, Absa's liquidity ratio,
Right.
Gets me a bit concerned, especially in terms of ability to fund your business.
Yeah.
Looking at where it stands, are you comfortable?
Very, very comfortable, and for the simple reason that the liquidity ratio disclosed in our financials does not entirely reflect the ability for us to fund the business. And I say that for simple reason because we are part of a group. We get funding from our group, which from a relative economics works for us as opposed to funding from the market. When you calculate the liquidity ratio, the expectation is that in that disclosure, you should exclude any borrowings coming from our group. That number is 23 billion today. So if I add that back, our ratio is into a high 30s. So from the ability to fund the business, absolutely not worried. I think there's always the question around where is it best to fund your business? And McQ, the regulatory limit is 20%. So eyes on that ball always. And if I pull back the 23 billion back into that ratio, is 35 plus. So very, very confident and comfortable that we will continue to fund our business operations, and we are not concerned at all.
On your Q3 numbers, one thing that I think is really interesting is basically your loan-to-deposit ratio.
Correct.
Given where it stands right now, don't you think you're exerting so much pressure on your deposits?
Well, I think, again, it's a relative conversation. So we've got the mix of our deposits, or that loan-to-deposit ratio is a function of the local currency book and the foreign currency book. We've seen significant increase in our foreign currency assets coming to the end of Q3. Just short-term trade loans, LCs, and guarantees to support our clients, especially oil importers. And therefore, in a sense, very quickly, you consume your foreign currency funding. So when you look at foreign currency loan-to-deposit ratio, it's within the limit that we internally manage. And similarly, the local currency loan-to-deposit ratio is also within the limit that we internally manage. So obviously, the former is higher than the latter. When you clap the two together, the average might look slightly up. It's seasonal. It's seasonal. And I guess the beauty about some of these ratios is if you have the options at your disposal. So with our revenue up 22%, our deposits only up 5%, we can give and take a bit of that revenue to get deposits overnight. So it's really fully within our control in terms of options. And certainly as we go to the full year, you'll see some improvement in that ratio.
And speaking about the FX, the operating environment was a little tight when we were starting this year, getting into mid. Are you beginning to see it thawing out?
Look, I think we are, particularly in Kenya, we are in the middle of a repricing cycle. You saw the first policy response of 50 basis points, another 75, you've seen a 50. And when you're going through a repricing cycle as a financial institution, you have to be generally aware that different asset classes will react differently to a repricing cycle. So fixed income will react differently than equities assets, than credit assets. And so we've been taking very deliberate actions in those asset classes. And that's where you can see the risk profile of our business relative to the return of our business is a good outcome. There's obviously pockets of leverage in terms of where can you apply capital to earn a return. There are pockets of rapid movements, which we have to watch and avoid and cautiously participate if we have to. I think it's playing the long game. I think it's playing the long game, and I think we are pretty well comfortable with the options. Now, what we cannot do is begin to forecast what's going to happen. I think it's when you're going through macro environments where conditions are way different, just a quarter out of your forecasts, you have to ditch the forecast and begin to think about scenarios. And so we are thinking about the playbooks in the scenarios we have to manage our business as we navigate what I think is still going to be a tougher macro backdrop in the next few quarters.
Speaking about the forecasts, I think when I look at your Q3 numbers, Absa has ramped up the provisions more than I expected. Right. And I'm seeing cost of risk ticking up. Are you really that concerned about the environment going forward?
So I think let's just take a few steps back. Remember and this has been a conversation every earnings cycle where it looks as though on a relative basis, Absa is escaping gravity. You know, when you look at NPLs, portfolio quality, we are running at less than 7% in terms of gross NPLs to total. In terms of gross NPL ratio, the industry is at 15. Our loan loss ratio today is 2.3%. It's retracing 2019, pre-COVID, 2.2. So on that basis, I think we're well positioned. Our coverage ratio has gone up to 67% from 62. The industry is at 59. So we are ramping up coverage. It therefore throws the question, what are we sensing in the environment? I think there's a philosophy within Absa, and one that I rally behind our colleagues, is when we sense, not see, but when we sense softness, we have to prepare for it. Because what happens is when you prepare for it, you only have an upside because you're prepared if things don't go as well. And if things go well, you have an upside because you release the provisions. So that's the mindset we tend to operate with. Just to give you a sense, as we're coming into COVID, we're already operating in a less risk environment in terms of, our portfolio is in a less risk relative basis in terms of pre-COVID levels. Coming out of COVID, we've actually begun to think about operating with less relative long biased risk. So in a sense, you're playing offensive defense, which is it's the season of soccer, right? Or football. If you're one up at halftime and you're going to the second half, you have to be offensive to make the 1-2, but defensive not to make the 1 neutral or draw. So that risk mindset of, yes, you can be offensive where you see opportunities, but defensive where you sense the environment is soft, is a philosophy that we live with. So you're seeing loan loss ratios 2.3, where they were pre-COVID, impairment up 1.6 billion, 3.4 to 5 billion. About $1 billion of that is because of customer assets we've written over the period, because there have been 60 billion of customer assets, right? So you take day one impact for those assets. 300 million of that is macroeconomic overlays preparing for the future. Now we've increased our forward-looking provisions to 1 billion shillings today. So there's an option. If you release the 1 billion shillings today, or don't take the additional 300, your loan loss ratio is 1.5, 1.6. And then you have to make a choice, do I keep it and still stay within pre-COVID levels, which is the philosophy that we have. I think it's, and I do expect across the street different managements will do different things. For us, it's very clear that that defensive, offensive is a philosophy we have to carry forward.
Moses, looking at your income profile, net interest versus non-funded income, we all expected that the acceleration would be quite significant on the net interest. But when we sat down together last time, you did mention there was a repositioning of fees through the Timiza product. Is this something which you have now concluded?
Yeah, so I think the numbers now are not comparable. When you look at Q3 last year and Q3 this year, we're now booking entirely Timiza revenue related to lending as interest income. There's a small portion still under fees, which is for payments business, insurance businesses through our Timiza platform, which are fees income. So those numbers are now really comparable. So you can say the 25% increase in net interest income is comparable, really driven by the 60 billion growth in assets, and yields have also gone up, from below 10 to about now 10.7, going to 11. We've priced in the first two cycles of 50 and 75, but you're only seeing the impact of the first 50 basis point because the financials are at end of September. So the 75 impact is more Q4, and then the latest 50 is after Christmas to next year. So you're likely to see the full potential of the repricing in our net interest income, even accelerating going into next year.
Okay, that's quite interesting. So one of the sweet spots in the numbers that I saw, I think, was on the return on equity. Could you give us more flavor? Because I think from a shareholder standpoint, it looks pretty good.
Yeah, so I think it's the denominator hasn't changed as much. We're still managing our common equity tier 1 capital ratio and capital position where we were same period last year. The numerator is where we've seen a significant upside. PAT, profit after tax, is up 30%. So immediately that will flow into the numerator of your returns. We obviously declared and paid an interim dividend as at the first half. So it contributes to the base, the denominator, slightly coming down, just given the impact of interim on your net asset value. But we are very happy that we are sitting at 23-24% return on equity. Cost of capital is 14.5. Do we see it going to 30s? Perhaps not. We'll probably be carrying excess financial leverage, so we have to manage where we apply our capital for returns. But certainly I think the days of diluting cost of capital are largely behind, unless there's another COVID moment where we have to deal with those cycles as they come. But it looks like it's going to be a good year for shareholders across the industry. Certainly for us, we are very optimistic as we go to the full year around overall return. The franchise value has increased when you look at what you're in control of in terms of net asset value. Annualized earnings per share, that's going up. And we are trading at a premium to book value. And in this market condition, that is something management is pleased about.
I see. Tell me, looking at your efficiency, cost to income, do you sometimes get the impression that maybe you're now cutting too much into the fat, getting into the skin?
I think we did the hard work in the years gone. We now have got the company where we wanted it to be financially from an efficiency point of view. 2017, that number was 55%. With rebranding, we touched 60. After rebranding, it came back to 50s. Then we started working downwards in terms of dealing with excess capacity, whether it's automating our back office, where 52% of our processes now in operations are fully automated. and we've moved the capacity there to the front office, doing sales and more relationship. Our headcount is down 25-30% in 5 years. To an extent now, last year we hired 250 people to join the organization in the service and sales front. And our real estate is not that heavy on our OPEX in terms of rentals, and the level of depreciation we are seeing from the investments we have done is also manageable. So I think then the problem statement is how much can we reinvest for the top line? Because we feel we're carrying excess cost capacity. Our target is 45% cost to income ratio. If I only keep revenue where it is and change 40 to 45, it throws a couple of 100 millions, if not billions of shillings for us to reinvest in the business, which is where you want to be as an organization when you're in a growth market, not in an austerity mindset, but the return on investment mindset. Am I going to get a return for these investments, for the cost or capital I'm going to apply for investments? No intentions to take it to below 40. I think we have to have the imagination to reinvest in the business. And I think that's where we are seeing now. The circular problem is that the more you invest for the top line and the top line grows, the more your cost-to-income ratio comes down. Yeah. But talking of options, it's one of the options that we are really, really proud about in terms of the options we have there.
Okay. Moses, let's close by talking about now the operating environment, starting from a global scene. Yep. We're closing the year 2022, which threw a number of curveballs at us. Yeah. We have the Fed sitting in deck. What are your general expectations here?
I think continuing uncertainty. You know, it's funny to say, but I think COVID gave us some certainty. You know, you knew things were going to be tough for a foreseeable future, and you managed that way. I think continuing uncertainty is something that we should be comfortable with. I think in terms of global economy, with Fed and other policy institutions around the world, we sense they're coming to the end of the repricing cycle. You've seen inflation starting to retract a bit. So maybe it's the beginning of the end of rate hikes. How long that beginning of the end will last, we do not know. I think now people have shifted away from talking about a recession to more soft landing in a shallow recession, where, yes, there'll be impact, but if they're well managed, we'll come out of this stronger from a global economics point of view. Now, I think there's a lag effect in emerging markets and the global economy. So the likes of ourselves and our neighbors on the continent, we may lag our way towards coming out of that uncertain operating environment. I think there's never been more important times for banks and financial institutions than when you're dealing with these macroeconomic environments, because we're there to manage risk, help clients and customers come out of these environments. We're seeing consumer squeeze. You know, inflation is a terrible thing. Energy or food prices or fuel prices. But we're also seeing people being prudent in terms of spending and tightening their belts. So I think jointly we can find a way out of this uncertain environment. But certainly I think over the long term our business is very optimistic. I think we are operating with a growth mindset, but cautious that we can always press the brakes if there's a challenge, as opposed to driving with your feet on the pedal, on the brake pedal. So it's a good time to be a banker, I would say.
Okay. Yeah. Locally, we have seen yesterday the KNBS numbers pointed at the first softening of inflation in about 10 months. The latest rate hike by CBK was lower than we saw in the last one. There's so much conversation around risk pricing and the credit referencing. How is Absa posturing itself looking into 2023?
So I think our models tell us that inflation is going to mean revert next year to probably, to the range of 5 to 7. That's how we're looking at things. Therefore, then rates may also begin to mean revert. The fact that we've got our approvals on risk-based pricing allows us to do more for our clients and our customers without damaging shareholder returns. So I think that option is welcome. Very pleased by the actions of the regulator that have been timely, effective, and targeted. And hence you're seeing this retracing of the inflation number so quickly in the repricing cycle. So we think everything is under control from that point of view. There will be moments of growth that we have to participate in, talking about where we apply our balance sheet. 40 billion of 60 billion of growth the last 1 year to the third quarter has been on short-term trade. Only 3 billion of the 60 billion has been from unsecured lending. Now, the opportunity may shift the other way around next year, so it's how we become dynamic. But I think whatever the environment throws at us and the market throws at us, and I think others in the industry, it's always remembering the social contract and importance of banking. We are there to ride these waves with our clients and our customers through and through, and I think that's certainly the commitment that I can make on behalf of Absa in terms of how we'll operate in the coming quarters.
Final question, Moses. There has been a mention of a directive to the National Treasury not to borrow locally at above 10%. Looking at your fixed income book, when you hear that, consider that, how do you see it panning out for your book?
We've dealt with the risk in that book. We started with a book that was over 10 billion in terms of trading, the held for trading assets that were in fixed assets. We came to Q3 to around 5 billion. We had dealt with the longer dated. We've taken the hit. Now, luckily, the FX side covered for some of that risk. That's on a net basis, you're not able to see that hit. But we took a hit on that. And so we are well positioned in terms of that book. Not to get technical, but I think we have to operate that book in short durations. So you're able to then react with those durations. High velocity, so you can churn. And low inventory. So you're not sitting on massive inventory and notional amounts that if the tide goes low, you're exposed. So that's our trading philosophy. It has to be that way because, you know, when the price environment is not stable, then you have to operate that way. As it relates to the directive, I think we can always and we will always support the government efforts around where borrowing should cross in terms of owners and providers and demand of capital. But that's a market exercise. I think the market equilibrium will determine that price. And we'll watch it and see where that equilibrium is.
Moses, always a delight. Thank you so much.
Thank you, Julian.
Thank you.
Thank you.